Traditional market trading was defined by physical proximity and human reaction speed. Success relied on manual chart reviews, high-latency verbal orders, and human emotion. Modern financial markets generate data at a volume and velocity that exceeds human cognitive capacity. The human trader has become a severe computational bottleneck. Modern algorithmic trading replaces human instinct with strict statistical probability, encoded directly into executing software. Today, we will systematically construct the core architecture of a Python-based algorithmic trading system. A professional trading system functions as an infrastructure of 3 distinct, concurrent subsystems working in perfect synchronization. The first module is the signal generator, responsible for parsing disparate data to identify a statistical edge. The second is the risk engine, which calculates position sizing and enforces absolute drawdown limits. The third is the execution router, engineered to navigate the order book and ensure regulatory compliance. The successful orchestration of these 3 modules transforms theoretical market inefficiencies into an automated software architecture. The signal generator converts chaotic raw market data into structured, quantifiable logic. This logic begins with the ingestion of market microstructure data. The system processes tick-level price data and limit order book depth in real time. This chart shows the application of Python's Pandas library, quantifying momentum and volatility by transforming raw numbers into moving average crossovers. Simultaneously, the module pulls in fundamental data, including earnings reports and macroeconomic indicators. Natural language processing converts this qualitative text into a quantitative sentiment score, allowing the algorithm to read the news for market-moving opinions. The module then evaluates the confluence of technical price action and fundamental sentiment. The final output is a probabilistic signal, a mathematical justification to enter the market. However, a raw signal without boundaries is financially lethal, necessitating a separate layer of defense. As the signal packet enters the risk engine, it hits a physical computational gate. The engine's primary function is capital preservation, shielding the portfolio from idiosyncratic shocks. Here, the algorithm executes dynamic position sizing, applying the Kelly criterion to calculate exact capital allocation before execution occurs. It continuously measures value at risk, assessing exposure against extreme volatility. The system applies emotionless stop-loss and take-profit parameters onto the trade signal. If their thresholds are breached, the signal is instantly terminated. The gate snaps shut to prevent the trade. Only signals that pass every mathematical risk check are approved for market entry. Long-term algorithmic survival is built on the ruthless mathematical throttling performed by the risk engine. The risk-adjusted order now enters the final module, execution routing. Large block orders dumped into the market create significant slippage, moving the price against the trader as they try to enter. To solve for market impact, the execution module slices the block into dozens of micro-orders, utilizing strategies like time-weighted average price, or TWAP. These micro-orders feed sequentially into the order book, consuming liquidity while minimizing the algorithm's footprint and spread costs. Modern execution logic must also include hard-coded compliance firewalls. European markets require pre-trade compliance checks under the Markets and Financial Instruments Directive, or MiFID II. In the U.S., the SEC mandates best execution through the National Best Bid and Offer, ensuring the algorithm finds the best price across all venues. Routing logic structurally blocks illegal manipulation, terminating attempts at wash trading or spoofing before an order ever leaves the server. The execution router is the climactic point of the architecture, transforming a theoretical construct into a palpable, legal force. This complete architecture operates concurrently, a continuous loop of data ingestion and risk-checked execution. This entire sequence occurs in milliseconds. Before live deployment, the system undergoes backtesting. We push years of historical data through the architecture to prove its statistical edge. This process validates the strategy's stability across various market regimes and volatility spikes. It also reveals dangers like look-ahead bias and mathematical overfitting, where the code is tailored too tightly to historical anomalies. This rigorous software engineering stands in stark contrast to the emotion-driven, manual trading methods of the previous century. An algorithmic trading system is not a static script. It is a highly disciplined, living software architecture that must evolve in lockstep with the financial microstructure it navigates.